What's going on, guys? Bryant here. Today is Sunday, October 10th, 2021. This is going to be a review into the price action from this past week, as well as what we can look for in the upcoming week right now in the stock market. So this chart that we're looking at is the SPY on the daily time frame. And this past week's price action has been pretty choppy. For certain traders, it's pretty difficult to trade this type of price action. Most traders like to see momentum in one direction. I actually am not the type of trader that likes to see the market trending in one direction for too long. I prefer trading during consolidation times. It's easier for me to interpretate the psychology behind the traders. So I'm going to talk a little bit about the psychology behind what was going on, and hopefully this can help some of you momentum traders out there. Now we're focusing just on the SPY and the ES futures because we can see things a lot clearer when we're looking at the futures. I'm also going to show you guys, so on the right hand side is the futures, and this is the TPO for the futures, so the time price opportunity, also known as the market profile of the futures. I'm going to briefly touch on this just to show you guys how you can get an even more in-depth look at what's going on behind the price action. Now switching back to the SPY, if you guys follow me on Instagram or if you're in the Discord group, you already know that I swung calls on Wednesday, and I'm going to show you guys why the decision was made, as well as why I was very comfortable in the trade. Even though we had a lot of overhead supply, I was expecting some sort of a gap up over the supply and some sort of squeeze into Thursday. Now, before we dive into some of the smaller time frames, let's actually just plot out the Fibonacci's real quick. And we know here goes our swing high to our swing low, and we know we had this 50% retracement in which the bears ultimately ended up driving price down, as well as we were at the 50-day moving average, right? So we know that. Let's remove that. Now let's take a look at what our current swing low is from right here, and this would be our most recent swing high. So right off the back, if you guys want to just continue looking at other YouTube videos, you don't really want to learn from a technical standpoint what happened over this past week. You're just interested in what's likely to come for the next week. I want to just ruin the surprise by right now and just let you guys know that this 50% retracement to this 61% retracement, so pretty much in this zone right here, the market should not come back below this zone in this upcoming week. And if it does, I would highly encourage you guys not to trade any type of price action in this area here, because the market should not come down here, and that's going to be a bad sign. And if it does, for me, it doesn't necessarily mean I'm going to look to short this price action, because I don't like shorting into a strong or presumably a strong demand zone, and I don't like shorting when I don't have a lot of conviction or a lot of reasons behind the trade. The next FOMC meeting is all the way on November 2nd or the 3rd, I believe. So the Feds are not really going to come out and say much. That's going to actually drive price down from a bearish standpoint. Now, granted, there could be some sort of surprise catalyst or something like that, but just for the peace of mind, I would not suggest you guys try to trade in between 432 and 428 on the SPY. Just let this level break down here and then see if you can try to catch some sort of a retracement back to the level before you catch the next short, which would be right about here. Otherwise, you're going to be dealing with some very choppy, unclear trades, and it's best to avoid those types of areas where that type of price action can occur. So mark this on your charts. If it's pretty much a 434 between 432 and 434, so about a 2-point range in this area here, it's going to be a good place to look for a dip buy in the SPY with a tight stop loss, and then presumably we'll get some sort of a pop back up to wherever the 50-day moving average is. So that's, instead of putting it towards the end of the video, just wanted to show you guys already where I'm thinking about for the upcoming week, what I'm actually waiting for, seeing if this gap fills, see if we can get a dip buy, something like that. Now, looking in a retrospective thought process, let's actually just jump to the volume profile. So right here, you guys, link to this volume profile custom study is in the description down below. It's just going to get it to match exactly the way in which I have it. I have my candlesticks turned off, so it's easier to see the points of control. If this is the first time you're hearing about this, I have a couple of other videos on this subject matter, but just know that this point of control right here is a very important level. So on Monday, we can see that right here. We can see the market sold off over the weekend, and we came down here, and price actually stayed down here for a while, and it formed the point of control right at this level, which was touched again on Wednesday. So this right here, if we're keeping it very simple, let's actually turn the colors on the candlesticks, and we'll keep this very simple to start. And I'm gonna layer on the complexity as we go along throughout the video, start layering in psychology behind things, especially when we get to the futures, because that's where we can see things a little bit more clearly. As we're looking at this right now, again, price sold off on Monday, and then we had this balancing area, and we can assume that demand was formed right at this level because buyers were holding price up, and then the market accelerated off of this level. Now, when price came back down to the level, anyone that was not a buyer at this level is going to be pretty eager to be buying at this level here, because now we know that there was a ton of buyers, presumably, that are interested in buying again or defending their position. So that's a little bit of the psychology behind things. So whenever the market gaps down and it's selling off into a demand zone, you do not want to be looking to go short. You do not want to be looking to buy puts. Your only thought process should be, hey, when am I going to get calls? So I already came into this day on Wednesday with that mentality, knowing I'd be buying calls sometime throughout the day. And I also was planning to sell puts because I know the price of puts were inflated on this day because the VIX was elevated, because it was a major gap down. Or not necessarily major, it was a big enough gap down to really cause a spike in the price for puts, and that's usually good for option sellers. But from the SPY, we're going to jump over the futures. But just remember the dates here. So we have Monday as a key date, and we have Wednesday, because this is essentially where we had some sort of a double bottom, if we want to call it that. We also could have called it a triple bottom from last week's price action from Friday, because this is actually where the demand was formed. I don't have the extended hours turned on because we're going to take a look at that in the futures, which would be right here. So here's the ES. On the left-hand side, this is our Monday during market open session. The gray areas would be the extended hours. So I'm pretty sure anybody watching this video would actually know that. So let me just actually extend this over here for a second, or better yet, let me just put this back here and make this, I'll make this full screen so we can just take a look at just this chart. So start a little bit with the psychology of things. This is Friday pre-market, right? Market rallies last week during the market open session. Now, I came into this week expecting a gap down and a sell-off. And why was I expecting this? If we want to start from just last week, it's just because whenever the market puts in a lot of trading activity during an extended period, so whether it's whether the market's in a downtrend for a while and then we enter in some sort of consolidation during the overnight session and then we run up, this is not going to be the bottom of the market more times than not. The same way, if the market is rallying and rallying and rallying and then we're at all-time highs and then we form an all-time high during extended hours and then we sell off, this is usually not going to be the all-time high for a while. The market is going to want to retest that level during the open market session. So you see here, this is during the overnight, this is pre-market, after hours, or something like that, and then this is during the open market session, so also known as the RTH, which stands for the regular trading hours. So during the regular trading hours is usually where we'll get a market top or a market bottom. So this activity right here is why I was expecting the price to come back down to it, because the market is going to want to be sure that this is actually the bottom from this current downtrend in which we're in from the all-time highs. So with that in mind, again, we have this demand that formed here from the overnight session and price rallied. It comes back down to it during the open session, and we can see how eager buyers were to get involved because we can see the wicks. It popped, it came back down, and it was retested one more time during the regular trading hours. What we ended up getting here, and again, this is the future, so what we ended up getting here was already some sort of a short-term uptrend that was actually forming. So this was showing that buyers were willing to defend this position from this demand that was created from Friday during the overnight session. Now going into Tuesday, we can see this rally. And then we come into Wednesday, overnight, the market came back down. During pre-market, we came right back down to this level. Now, during the time, this type of price action always looks scary. It always makes people feel like, oh, the market's dumping. We're going to, break support. We're going to sell off. We're going all the way down another 50 points, another 100 points. But when you just take a step back and you think about it, it's like, why would the market continue to go lower? If we think about the psychology of things, here are the bulls defending this area. Bulls clearly win here. Bears win the next day, but they don't win as strong because they weren't able to actually put in a lower low. It actually stopped here, which was higher than this price. So price actually went higher. This is going to give bulls a little bit of confidence. And remember, the market generally always almost want to go up. It's only going to really go down if the Feds change something with interest rates, or if there's a real significant macro sort of catalyst like last year's pandemic, or if there's a liquidity crisis or something like that. But if it's just regular short-term bad news, it's just going to really cause a little bit of a sell-off, but it'll be recovered relatively quickly because we know the long-term trend for the S&P 500 is just up. It's just constantly going up. So keeping that in mind, the bulls don't really need much convincing whenever it's time to buy. Everyone's pretty excited to always get involved in the stock market. So when we get another type of extension like this to the upside, right, on Tuesday, we get this selling. Now this selling, the futures market closes, it shuts down temporarily just for like 30 minutes, I believe, or an hour or so, and then it opens back up at 6 p.m. So this is what this gray dashed line is here that you see. This is 6 p.m. and this is where the session actually starts. It goes from 6 p.m. all the way till the next day at 5 p.m. or something like that. Don't quote me on the exact times, but pretty much after 4:15, I stop trading the futures anyway if I'm ever in a position, and I just come back at 6 p.m. because that's the time I know for sure it's safe to trade again. If we think about this, here on Tuesday, bears start shorting The futures market pauses for a bit, opens back up at 6 p.m. It starts shorting all night long. There's some sort of a bear flag that forms. They continue to short. So they've essentially been shorting from 6 p.m. all the way till 6 a.m. the following day. That's 12 hours of just pressing the sell button. If you think about this as some sort of a fight or a boxing match going on, this is the bulls already feeling confident from here. Bulls are feeling good. Bears are giving it everything they have to try and push price down, and they want to take out this low because this is the most recent proper swing low. Bears want to drive price down and break this, but they've been fighting all night long to get price to get back to that low. Eventually they're going to be tired, but overnight, who's been pretty much resting? Who's waking up the next day excited because now we're back in this demand zone. We're back in an area where the bulls feel pretty safe. When you think about it that way, you're coming into a place where bulls are fresh, they're feeling good, and they feel safe. You do not want to be a bear down here. You do not want to be looking to buy puts. You do not want to be looking for shorts. The only idea you should be having, or the only thought process you should have is, hey, if this level breaks and comes back to it, I want to look for some sort of a short right here, and that would be the retracement short, because then you know it's pretty safe and you know bulls have lost this battle. And all of the bulls that were buying here, all of the bulls that were buying here and here and here, once this breaks, they're now going to be nervous. And once these bulls are now nervous, the first thing they're going to want to do when price comes back to a level that it's close to their average, they're going to want to close the trade, which means they're going to be selling, and that's what would cause the next sell-off. If you are a bear and you see this is happening into this area, you're pretty much fighting against not only the uptrend that's happening right now, because yes, we're in a downtrend. If we zoom out and we look on, a daily chart, or we look on the monthly chart, or we look on an hourly chart for the start since the start of September, we'll see that we are in a downtrend. But for this current week, starting from last week Friday, we are in a uptrend. So being a bear shorting into this, I would make the argument that you are shorting against the trend, especially in this region here. So that's why when we see the market ends up bouncing here, but then coming right back down. And do you see how fast bulls actually came in and defended the area? Price hardly stayed down here before wicking right back up. Now we're looking at a 30-minute time frame. So price did not even sit down here for 30 minutes. It hardly touched the level and bounced. So this right here is an indication that you should no longer be looking for shorts, because it's showing too much conviction, too much eagerness, and just too much excitement behind the bulls. So if I was to now, so let's just switch this back on, and I want to show you guys the market profile. I posted on Instagram a screenshot of the market profile, and in my Discord group, I actually posted that the market looks good, and I was considering swinging calls, and then I ultimately ended up swinging calls. It's about looking at this right here. When you see this type of activity, this is a lot of emotional trading, which is why I don't like trading during times of extreme momentum, because I know it's just everyone being super excited or everyone being super scared. It's just too much for me, my personal style. I'd rather let levels get defined, and I want to be able to analyze and read what's actually happening and look for that 1 to 2, maybe 3 really solid trades for the week, and just put a little bit more size on those, because I have a lot more conviction on them, which means I'm not going to stop out if things just go wrong for maybe 5 or 10 minutes. It allows me to hold it, walk away for a bit, see if anything changes. On the left hand side right here, this is what's known as the TPO market profile. So it's pretty much showing the place in which price spent the most amount of time at. So what you see right here, this would be this price action if we come right here. So we said already that the market consolidated down here. If I was to actually draw a demand zone around this, and we could say the market was in this zone for a while and we were forming some sort of demand. Let me just make it green for you guys. And if there's anything you're going to take away from this and foremost, I'll tell you, here's one gem you do not want to short when the market gaps down into demand. Right, so here goes our demand zone. Here goes Tuesday into Wednesday. The market has gapped down now, and it's coming into a demand zone. If I was to take this right here, and let me actually just put a level at the top of the demand zone, I'm going to just change this, and let me just mark the level off to make it nice and even. And I'll make the level a little bit thicker, and we'll just make this a green line, and we're actually going to call this demand, and turn this on. So now we can see here is our demand zone, same level right here, same level right there, right? Okay, next let's draw some sort of supply. Let's actually duplicate this, bring this up right here, And bring this down for a second. And then let's actually make this red because it is our supply zone. Lower the opacity a little bit. Okay, now we have a clear demand and supply. Let's duplicate this so we can actually see the level on the other side right here. Change this to red, call it supply. What this chart on the left hand side is showing us is the amount of time that price is staying at a certain level. So right here, this is saying that on this date, between this date and this date, during this trading session, so from 6 p.m. into 5:30 p.m. the following day, all the trading at this level, this is where the market spent the most amount of time at. So at 43.30 and so forth. So that's what these golden lines right here, and this is what this profile is showing, how it's protruding out at certain levels, so which is important. What I want to show you guys is when the market just slices through certain levels like this, it leaves pockets in the market profile. So we see right here, if we take a look at this pocket right here, it does not look good. This is showing a little bit of emotional trading. It's showing that the price is just slicing through a level very quickly. The same thing whenever we see this types of price action. So we can see it on the chart whenever we get this, whenever we get this. But if you actually want to see it and you want to see confirmation, because if we were looking at a daily chart, we would not know what's actually happening in between the certain levels here. When you're using the market profile, you need to have it on a 30-minute time frame. But I wouldn't suggest you guys change around your entire trading. This is only something that I check maybe once or twice a month, or whenever we're in some sort of huge congestion or consolidation zone, and I just want to get a deeper insight to what's happening. So what I saw here was this pocket right here, this pocket right here, but I liked that you see how much time the market was staying in this area. I liked that it was, in a sense, filling up this pocket, and all this trading that was happening in this area filled the void. And whenever you see voids being filled like this, in my opinion, I read it as if the market is being repaired, because that's what the market is constantly trying to do. The same way like most traders know that every gap is usually going to get filled in the SPY, it's because the market doesn't like to leave unfilled places. So this type of emotional reaction, this is just a lot of people shorting here from pre-market on Friday, then realizing that they have a bad average on their short, so then they get squeezed out. Market comes back down, they're super excited to just get out of their short position back for a break even, and that's what will cause this sort of a short squeeze. When you get this short squeeze, it's not necessarily real buyers. If you know anything about shorts, when shorts are covering, it's market orders usually. They're not sitting on the bid hoping to get filled at a passive price. They can't send limit orders because they don't know how fast price is going to fly. And if you know anything again about shorting, there isn't, in theory, an unlimited risk. So they have to get out as quickly as they can, and that's what causes short squeezes, and that's what causes price to fly through levels pretty quickly. Then you get shorts coming up here knowing that there was supply that was created in this area from before, so they're now shorting. We can see right here, this was the TPO point of control. So right here, shorts are pretty excited to be shorting because they know at this level there's going to be a ton of supply up here, so they short here and they're shorting here. So we get this sort of short selling that's happening right here, and then price comes all the way back down. We have the same bears from back here that shorted with this poor average, and they're excited again. This is their opportunity to get out for break even because they sat through this squeeze right here. They're excited to get out. Then you have other shorts that are still coming in because you can call it greed, you can call it the momentum traders coming in, because the momentum traders coming in, they're just going to continue to keep hitting the bid, which means they're just going to keep shorting and shorting and shorting and shorting and shorting until the momentum stops. Now, it's very hard to tell when the momentum stops, especially if you're a trader and you're experiencing greed, euphoria, you're shorting, you're making a lot of money very quickly. It's very hard to turn that trigger off to say like, okay, I've made enough money. So they're still hitting the short button down here, and then they're shorting, which means they're selling, and then you have buyers down here that are coming in to defend this level, and that's what's going to cause a lot of this choppiness right here, and then ultimately the bulls will end up winning. Now, bulls end up winning because there's going to be more bulls defending this area, because at this point the risk reward is much better for a bull. If you're going to be buying down here, your stop loss is going to be below here, but you can target up here. So from a risk reward standpoint, you're pretty much just risking this area, and your reward is all the way up to here. So this is going to inherently be, you're risking one to make 1, 2, 3, a little bit more than 3. And if we were to look at the exact numbers, if I was to draw this out right here, if you buy this and your stop loss is down here, you're risking about, we can say 25 points to make all the way up to 70 something. So we'll say 75. So you're risking a quarter to make 3/4. That is a great risk reward trade. But as a bear, if you're shorting down here, where's your stop loss? Are you putting your stop loss over here? Are you targeting here? This means you're pretty much risking all of this to make this. It doesn't make any sense to be shorting here. So now if we flash forward, we can see another squeeze in a sense happens, because now this is again bears that have been shorting, the momentum traders that have come in, they're still trying to get price to go lower, and they tried it again right here, but it did not take out this low. And that's important because that's going to make bears nervous again, so we squeeze right back up. Now we come into Wednesday, bears once again try to defend this area and short it, and at this point they're shorting, but this is at this point bulls that have been sitting on the sideline are very confident coming into this day, because now it's a proven level. Bulls have defended it. There's still a ton of demand in this area because of how long price spent here. We can see price was still not in this demand zone that much. So there's still a lot of potential buyers on the sideline. Here we can see that the price came into this demand zone and it still didn't sit in it that long, but we can see that each of these sessions, we can see that it came down here and it came down here and it came down here, and this is how much time it spent in this demand zone. It was not that much time, but it was enough volume if we look at the volume point of control. So I'll actually turn that on for you guys for a second. Let's go to our studies and let's put on the volume profile. Right here, show studies. And at the time, this looked a little bit different, but you guys can see here was our volume point of control. It means that this is where the majority of volume occurred for this day. And if I were to put on, I'm actually going to turn on, this is what my levels were looking at the time, because I had marked off from Friday, October 1st, pre-market. This was our point of control, and we can see the point of control was constantly being defended, and even all the way up to Wednesday, it was defended here. In my Discord, if we come right here, not there, not in the public chat, but in the premium section for the futures pre-market tab, coming into Wednesday, the game plan. So this is where I already said to you guys. So this is what the market was looking at, saying this is where we want to go short. If this demand zone had broken and we came back up, that's where we want to look for the short. But then this is exactly what we were talking about right here. So from a risk reward standpoint, as I believe I was saying right here, I was talking exclusively about risk reward. So this is great risk reward for a bull. But what do the bears have? The risk reward isn't as great yet unless something shocking happens, like a bad catalyst or a breakdown of the demand zone. And again, I was specifically talking about if the 4,300 level was to break after the market opened. So I'm already talking about what's likely to happen going into the market open session, because if this level broke and then we came back down to here, and then bulls defended this level again, and we ended up holding above here, the people that would be afraid would be bears, because bears know if this level squeezed, look what happened to them the past couple days. It squeezed and then it squeezed. So bears are already going to be the ones that are more emotional. Bears are the ones that probably didn't sleep well overnight, because they're assuming they left their algorithms on to be shorting all night long. They don't know what they're waking up to. They're probably not sleeping well. Meanwhile, bulls probably had limit orders down here to buy with the stop loss below here, and they're sleeping comfortably because they know exactly what their risk was. And bears are going to be super tired coming into here, so they're more than likely just going to take profits, because why deal with this type of buyers down here? Why deal with a fresh opponent? Wouldn't you want to just take your profit and then let price reset for a bit and then see if you can win on the next break into the level, and then really get aggressive once we get below the level? But coming down into the level, it's just not smart trading, especially when this gray level right here is VWAP. And then I was just pointing out the 2-day anchored VWAP, which was all the way up here. So this would already be the target for bulls. And I believe that's what I had mentioned right here. So then it's about understanding where is there likely to be chopped. So I said if 4,300 breaks, the bears need to hold price below the value area high. So the value area high right here on the volume profile is this blue area right here. This whole blue area is the value area, and then the top of it is the value area high, and the bottom of it is the value area low. So I drew this level out here, extending it and saying at 4,306, bears need to keep price to close below here on a 30-minute time frame. However, knowing that this right here was going to be a lot of congestion, I said between here and here it's likely to be a lot of chop. So above there things will get choppy for both sides, but bears will start to feel the pain and will most likely cover. Now this is pre-market, so this is at 9:15 a.m. and this right here is about, if you could come into the day and understand what's likely to happen, as well as know not to trade in this type of area, just wait for the winner and then join the side of the winner. It will keep you out of a lot of losing trades, and it will also keep your mind feeling fresh, because if we jump into, let's look at it now on a let's actually just turn back off the studies, and then we actually jump to a smaller time frame. So I'm going to go back to the SPY and we'll jump to, here goes the smaller time frame. So do you see right here? And if you guys want to see actually the futures to keep it consistent, switch over to the futures chart for you guys. I'll turn off all of my levels, so we just have the new levels that we just drew, and you guys can see right here, this is exactly what ended up happening. We got very choppy price action, and this will drive you crazy as a trader. I went away, I closed my charts for this day. I was not actively paying attention too much because I knew it would be exhausting trying to figure out, and you don't want to predict. Now granted, if you're a scalper, there's a ton of trades here, because if you know there's going to be a ton of supply in this area, or there's going to be a ton of battle between the bulls and the bears, you can try and scalp this all day long. But for me, I'd rather just wait, let all the bears get exhausted, and come in and enter a swing trade. As well as I shorted puts down here. I made adjustments to a couple iron condors in which I had, and then I just let that position continue to unfold itself, as well as buying calls, and ultimately we ended up getting a huge win, because from buying calls here, the market ended up squeezing really well. This is a big move on the ES. And if we go to the SPY, I believe I'll come back to the public chat right here. Link to the description for the Discord, by the way. So right here, I said we closed off yesterday's point of control today, and even though we have a lot of supply above us, I figured it'd be worth it to swing SPY calls. If we gap over the supply tomorrow, it could really start the short squeeze that the market needs. And at this point, I was talking about right here, so this was our VPOC, which is our virgin point of control. The market was closing it, so it still was not too late to get into SPY calls, because if we gapped over this supply zone, the market was going to squeeze, and we ultimately went all the way up to 44.20. So from here to here is a big move, and especially from down here is an excellent move, and that's when we're talking about risk reward and identifying the side of where certain traders are going to be in pain. And in this case, bears are going to be in pain, but you can see it from pre-market, being able to read the price action, looking at the market profile, seeing how things look pretty good, seeing the emotion on the chart. Here's emotion, here's emotion, here's the emotion being tested, because at this point, if you're a bear, you just want it to go back down, but it's not going down. It's holding up for so long, it's going to drive you crazy, because then once you lose, you're going to get this huge loss. It's not going to be a quick loss, and bears know this. Whenever they're wrong, the loss is going to be very aggressive, which is why there's a such thing as short squeezes. So as I'm recording this right now, it's 7:11 p.m. and the market, as we can see, is already, it opened an hour ago, the futures market on Sunday, and we're coming back down. We're at this point of control. We got this point of control back down here. We have a support and resistance level down here, but as I mentioned in the video to start, I showed you guys very briefly. So if we actually just zoom out and we draw our same fibs, so from here all the way up to here, I already said the market should not get below this area, because this is where we should hold. This is where the demand really turn things up. So in this area, I would be looking to be a buyer, but below this, something is wrong with the market. I'll probably give it a try down here with a tight stop loss, but if this level breaks, we can expect the same trade idea. It's only if this level breaks, I would be looking for, well, assuming it breaks over here and we come back up to here, this is where I would take my short, because my stop loss would be probably right over this level, and I would be looking to target. We have this VPOC right here, which is a virgin point of control. I forget what dates. This dates back a couple months ago, I believe, but then we would expect maybe this to even break, and we would go all the way down to the 200-day moving average on the daily. So if we were to actually zoom out right here, here's our 200-day moving average that we could potentially target, which would be right around this area. But it's only if this demand zone breaks, and which would be this uptrend right now that we're currently in. It would take this uptrend to break. But for a newer trader, I would strongly suggest, again, you guys just stay out of this region right here, especially if it does not hold this week, because it should. And I only want to do when the market does what it should do, or what I think it's most likely going to do. It comes down to here and it bounces. I know why this is happening. It's a bunch of bulls looking to defend the area. It's a bunch of bulls that missed out on Wednesday into Thursday, and they're excited. It's a 61% retracement. There's a ton of reasons why it would make sense to buy here. The next target would be either the 50-day moving average, or coming back up to this double top, or any other, key level that would unfold itself, any other major supply zone that might form. I actually just realized I spelled supplies wrong. Suppy. Well, maybe that's the new supply zone, Suppy. Anyway, hopefully this video brought a little bit of context for certain things that you want to look for. The Discord premium section during pre-market, if there's something relevant to discuss, I will post it out here. And if it's nothing that I think is relevant, or the information doesn't look that clear, then I'm not going to try and guess or predict what's likely going to happen if I don't have any type of edge. This right here was a clean chart to me, and it made complete sense. Just knowing that we had this strong point of control, we were in demand zones, the market profile looked great, everything made sense from a psychological standpoint, the risk reward was great, a lot of things checked off. And if a lot of things don't check off, then it means sit on your hands for the day, or trade small if you really feel the need to trade. Just keep the risks tight, don't lose too much money, especially right now. October is the most volatile month in the market historically every year, so keep things light. And then we have this big FOMC meeting to start off November, so wait till after that. Just keep trading small until then, until you can actually read this type of action and you're trading around key levels. So if you like this video, make sure to hit the like button, share the video with anybody that you think can learn from it, and subscribe to the channel if you're new to the channel, and I'll see you guys in the next one.